Australia just rewrote the rules on investing. The 50% capital gains discount, the single biggest tax break investors have had for over 25 years, is being scrapped. In its place, a brand new system, a minimum tax floor, and tighter rules on property. And the question landing in my inbox over and over is the same one. Is it even worth it anymore? Should I just leave my money in the bank? Should I be looking overseas? So, let's deal with this properly. No hype, no panic, no headline chasing. Just the numbers, what actually changed, and what it really means for someone trying to build wealth slowly and sensibly in this country. Because the honest answer is more reassuring and more interesting than the headlines suggest. First, let's slow down and separate the noise from the substance. In the May 2026 budget, the government announced it wants to replace the 50% capital gains discount with something called inflation indexation, starting the 1st of July 2027. Alongside it, a minimum 30% tax rate on gains. And separately, negative gearing on existing residential property gets wound back to new builds only. Now here's the first thing almost nobody is telling you. This is a proposal. It is not law. There's no final legislation, no tax office guidance, and the fine print on how it's all calculated is still being worked out. So anyone selling in a blind panic right now is reacting to something that hasn't actually happened yet. The second thing, it's mostly forward-looking. If you already own an investment, the old 50% discount is locked in for every dollar of gain up to the 30th of June, 2027. Only the gain that builds up after that date falls under the new system. Your existing holdings keep a long runway of the old treatment. Nothing you own today gets taxed retrospectively at the new rate. So this isn't a wall that just dropped in front of you. It's a change to the rules of a game you're already winning. And the change is gentler than it sounds. Here's where it gets interesting, because the 50% discount didn't just vanish into thin air. It got replaced. Under the old system, you held an asset more than a year, and you only paid tax on half your gain. Simple, but it taxed your whole gain, including the part that was just inflation doing its thing. The new system flips that. It indexes your purchase price to inflation and then taxes only your real gain, the growth above and beyond inflation. Let me make that concrete. Say you put $100,000 into the market and held it for 10 years, with inflation running at around 2.5%. If your investment grew modestly, say 5% a year, a typical investor pays only around $1,300 more in tax under the new rules than the old ones. On a $60,000 gain, that's barely a rounding error. And if your returns were lower than that, the new system is actually cheaper. Below roughly 4.5% a year, indexation beats the old discount because inflation eats so much of your gain that there's very little real profit left to tax. For modest returns, you can genuinely come out ahead. So where's the pain? It's concentrated at the top. If your investment grew strongly, say 7% a year, that same investor now pays around $7,500 more. And on a real high flyer, the gap widens further. The new system hits large real gains, held for a long time, hardest. That's the design. That's the whole point of it. One more wrinkle worth knowing, that 30% minimum tax actually bites hardest on lower income earners, because it strips away the benefit of their lower tax bracket. If you're on a high marginal rate already, the floor barely touches you. If you're on a modest income, it can take a bite the old system never would have. So the picture isn't simply rich people pay more, it's more nuanced than that. And it's worth understanding which side of the line you're on. Now here's the part that should take the pressure right off. And it's the part the headlines completely skip. Superannuation is untouched. All of this, the indexation, the 30% floor, applies to money you invest outside super. Inside super, The rules haven't changed. The concessional treatment that makes super the most tax-effective wrapper in the country is still sitting there, exactly as it was. So the bread and butter strategy, make the most of your super, then invest the surplus. That engine is still running at full power. And the negative gearing change? That's property. Only property. If you're a long-term investor in low-cost, diversified funds, it does not touch you. Your shares, your index funds, your exchange-traded funds, completely unaffected by that part. So step back and look at what actually changed for the everyday investor. Compounding still works. Diversification still works. Low fees still beat high fees. The tax advantage power of super is fully intact. The core machine that builds wealth in this country is exactly as it was last year. And this gets to the real heart of it. The case for investing was never, do it because of a tax discount. A discount is a tailwind. It is not the reason. The reason you invest is that productive assets, businesses, the broad market, the economy itself, tend to grow over time, and owning a slice of that growth is how ordinary people build real wealth. A tweak to how the gain is taxed at the end does not turn a productive asset into a bad one. Here's the test I'd put to anyone feeling spooked right now. What's the alternative? Cash in the bank still quietly loses to inflation every single year. Guaranteed. That hasn't changed. Running overseas brings its own tax complexity and currency risk, and most other countries' tax gains too. The grass isn't obviously greener, it's just a different shade. So the question was never really, is investing in Australia dead? It's a much smaller, calmer question. Where do I hold what, and when do I sell? And that's a question you can plan around, not panic around. So what do you actually do with all this? A few sensible moves. 1. Don't panic sell to beat a deadline on a proposal that isn't even law yet. Selling a good long-term investment early and triggering tax now to dodge a change that might not arrive in its current form, that's letting the tax tail wag the investment dog. Don't do it. 2. Understand the transition. Every dollar of gain that builds up before July 2027 keeps the old 50% discount. That's a meaningful window, and it rewards patience, not haste. 3. Lean into the wrapper that didn't change. If super is still the most tax-effective home for your long-term money, and it is, then making the most of it just became relatively more valuable, not less. 4. Keep good records. Under indexation, your purchase price and your dates actually matter for the calculation. Tidy records today save you a headache later. And 5. If you're sitting on a large holding with a big gain, that's exactly the situation worth getting personal, professional advice on before you do anything. This video is general information, not financial advice, and your own numbers deserve a proper look. So, is it still worth investing in Australia? Yes. The rules got a little less generous at the top end, a long way down the track, on a proposal that still has to pass. For the everyday, long-term, boring investor, the kind I make these videos for, almost nothing about the actual strategy has changed. The unglamorous truth is the same as it's always been. Spend less than you earn. Invest the difference in low-cost diversified assets. Make the most of super. And let time and compounding do the heavy lifting. Tax rules will keep shifting underneath all of that. Boring still wins. I'll keep tracking this one as the legislation firms up. If it helps, subscribe, and I'll see you in the next one.